It's a very mixed bag at the moment. As you know, different automakers are exposed differently. And so there's a lot of anxiety from the dealers that are dealing with German manufacturers.
It would be devastating, you can say that for sure. And we just saw, we're talking about billions of dollars here in value that German car makers export there. And that's going to be a lot more difficult.
Ford dealerships are reportedly calling previous buyers right now, desperately offering more than the original purchase price for used cars. This shocking turn signals the rising tide of auto chaos sweeping across the United States. In the last days of March 2025, an unrelenting wave of buyers flooded showrooms, scrambling to secure new cars before tariff-driven price hikes took hold. The auto market had braced for sluggish spring sales. Instead, it registered the highest monthly totals in 4 years. Alarming headlines pointed to a looming threat: painful import tariffs that might push prices of certain models beyond the reach of everyday Americans. Suddenly, a routine purchase morphed into a high-stakes race against time. Industry insiders say these tariffs, now scheduled for early April, threaten more than mere price tags. They signal a fundamental power struggle over who controls global trade. Stocks soared, panic spread, and analysts warned that this last-minute frenzy was only the beginning of a much larger economic confrontation. Brace yourself, because this runaway tariff train is about to upend everything we thought we knew about the car business.
The car industry is so important. It is really the lifeblood of the German economy. I mean, Germany imports, in the last couple of years, it's imported more than 400,000 cars to the US each year. It accounts for 13% of those of German car exports.
At first glance, the number sounded too bold to be true. March auto sales surged by over 13% compared to the previous year, surpassing 1.5 million vehicles sold nationwide. It was a thrilling disruption to the usual seasonal patterns, spurred by a wave of fear that new tariffs, some as high as 25%, would slam prices skyward. This policy, announced near the end of March 2025, blindsided the industry and ignited frantic consumer behavior. Buy now, or risk paying thousands more in just a matter of days. Beneath the surface lay a vast, tangled web of cost spikes. According to fresh estimates, tariffs on steel, aluminum, and finished car imports could add $4,000 to many sport utility vehicles and over $20,000 to certain luxury models. Those who shrugged off the possible damage quickly discovered that even American brand vehicles often rely on imported components. That means no one, not even the domestic giants, is immune from how these extra taxes might ripple through the supply chain. Enter the White House. The administration insisted that restoring fair trade practices justifies the short-term pain. Critics, however, saw a different story, one where the government's show of strength risks sabotaging long-established supply networks crucial to auto production. For them, these tariffs represent a blunt instrument, one that shoots up costs and clogs ports with unsold stock. In the days after the big announcement, multiple shipping lines reported heavier traffic from Europe and Asia as manufacturers rushed to beat the April 3rd tariff start. Consequently, U.S. port warehouses bulged with foreign-made vehicles, some of which found themselves barred from quick release unless importers ponied up the new fees. Judging by the latest rush of March buyers, consumers saw the warning signs and jumped into action, defying the usual slow weeks that historically follow winter promotions. No one wanted to risk the rumored spike in sticker prices if they hesitated too long. Experts caution that while the current panic boosts short-term figures, it could be a Trojan horse. Once the tariffs fully sink their teeth into the market, sales might crater, leaving the entire industry in disarray.
About 30% of the inventory is assembled in the US, but parts come from all over the world, so all of them are going to be affected by the tariffs.
Under this intense spotlight, three main factions emerged. First, domestic automakers like Ford, General Motors, and Stellantis have played a high-stakes balancing act. From the outside, they appear to reap an advantage. After all, if foreign imports get hammered with extra tariffs, locally assembled trucks and sport utility vehicles might dominate. But that silver lining is overshadowed by a sobering reality. Many domestic models rely heavily on imported parts, pushing up their costs too. General Motors, riding a recent wave of success with electrics, clocked a near doubling of electric vehicle sales in its first quarter. Still, executives privately admit tariffs on batteries and other Chinese-sourced components could derail that momentum. Meanwhile, Ford recorded a modest overall first quarter dip, but posted a jaw-dropping retail surge in March, nearly 20%, fueled by fear-driven buyers desperate to beat the tariff timer. Even more paradoxical, the best-selling F-Series truck soared by nearly 40% month over month, proving that news of impending price hikes can spur a last-minute bonanza. Second are the unions, led by the United Auto Workers. They publicly applaud the tariffs, seeing them as a path to rebalance decades of lopsided trade deals. They hail this moment as the end of a free trade fiasco that exported far too many American manufacturing jobs overseas. But the irony is bitter. While union leaders rally behind new barriers, many plants cannot simply retool overnight. Some employees face furloughs if reduced imports disrupt production schedules. Profit-sharing checks might shrink if material costs jack up overhead faster than prices can compensate. The rank and file thus stands precariously on the line between celebration and dread, hoping new trade rules eventually steer more assembly work onto American soil. Third are the foreign automakers and luxury brands. This group includes European marques like Mercedes-Benz and BMW, as well as Asian producers such as Hyundai and Kia. Historically, imported nameplates have commanded a huge slice of the US market, but with an abrupt tariff roller coaster, these companies scramble to protect their margins. Hyundai, for instance, scored a remarkable boost in hybrid and electric sales in the first quarter, up nearly 70%. Yet behind the scenes, executives worry that ongoing tariff uncertainties will sabotage the fragile momentum they've built. European and British car makers, in some cases, halted fresh shipments or stashed vehicles in ports, an expensive holding pattern. Unofficial reports imply that Jaguar Land Rover indefinitely froze certain shipments, and inventory soared as luxury dealerships struggled to absorb wave upon wave of pre-tariff cargo. Dealerships themselves face a frenzy. They are caught between a rock and a hard place. Pass along sky-high import taxes to customers or swallow part of the cost to stay competitive. Some push borderline absurd deals on used inventory, offering buyback premiums just to replenish certain segments. The scramble isn't just about big profits, but about survival in a market redefined almost overnight by tariff threats. Meanwhile, consumers swirl in the middle of this turmoil, uncertain whether they should pounce now or wait in hopes the policy might reverse. Many took the leap, fueling the record March numbers. Others fear that once the dust settles, a brand new car might be priced beyond imagination. Every stakeholder struggles to adapt, and no one is entirely sure how this high-stakes chessboard will look in a few months' time. If these tariffs represented a solitary domestic policy, the repercussions might be contained. Instead, they're fanning out across the globe like ripples from a meteor strike. When the United States hammered foreign-made autos with a steep tariff, certain trading partners responded in kind. Canadian officials threatened punitive taxes on vehicles containing significant American content, intensifying an already tense dynamic in cross-border auto supply channels. Analysts warn that these tit-for-tat escalations may force some global automakers to consider rerouting production or reclassifying car origins, adding yet another bureaucratic layer to an already tangled process. Retaliation from overseas appears to grow each day. European and Chinese consumers, influenced by rising nationalism and resentment, started boycotting American brands. Some luxury retailers in China removed American-branded vehicles from prime showroom spots, shifting promotional emphasis to European or local automakers. The broader travel industry has begun to note a downturn, as anecdotal reports mention Europeans opting for non-US destinations, reflecting simmering public discontent with American trade policy. At the same time, half of all US vehicle sales historically depended on imports in some form, whether as fully built units or as essential parts. That means these tariffs have the potential to cause massive disruption in multiple nations, prompting automotive supply chain nightmares that unravel everything from raw materials to electronics. Crucially, the meltdown at U.S. ports underscores how swiftly global commerce can clog. Multiple dock operators reported an unprecedented backlog, foreign-made cars stacking up without clear instructions from corporate offices on whether to pay duties, reroute shipments, or hold in limbo. Insiders caution that if the standoff persists, these thousands of idle vehicles could overlap with even more shipments arriving, pushing the entire port infrastructure toward gridlock. Some compare the mounting frustration to the supply chain crises of yesteryear, except now the cause is not a pandemic, but a self-inflicted policy decision. The biggest question haunting everyone is how long any nation can sustain this type of economic brinkmanship before cross-border commerce grinds to a halt. As of early April 2025, the promised tariff spike is now in effect, though it could be lifted just as quickly if political winds shift. In the short term, dealers are savoring the afterglow of a record-smashing March. Yet behind that triumphant facade lurks a deep anxiety about the weeks to come. Will April see another buying rush or the biggest drop in showroom traffic in a decade? Economists differ. Some believe that the short-term panic drained consumer savings early, leading to a slump nobody can fix without new incentives. Others predict that as soon as consumers see the inflated prices, they might scale back all big purchases, not just cars, plunging the broader economy into a downturn. Meanwhile, automakers are wary of placing colossal bets on domestic factory expansions. One well-publicized statement from an industry executive warned that if the tariff wall crumbles next year, any newly built plant could morph into a money pit. The unpredictability alone is stalling billion-dollar investment decisions. Foreign automakers might simply wait out the storm, closing the pipeline to U.S. ports until the rules stabilize. In the darkest scenario, job losses could spread nationwide if plants run at partial capacity or shut down altogether due to parts shortages. In a best-case scenario, officials could broker a quick compromise, throwing open the doors to normal trade before the full brunt of the policy is felt. Skeptics argue the administration seems committed to pressing its advantage, stoking domestic manufacturing in a show of unwavering resolve. A few contrarian voices highlight that some Chinese manufacturers, far from being stifled, are accelerating their push into advanced battery technology to circumvent these tariffs. No matter which side ultimately yields, the stakes could not be higher. Billions in manufacturing costs, tens of thousands of jobs, and a reconfigured landscape of who builds what for whom. For now, the show goes on. Cars continue to roll off assembly lines, some at record pace, others forced into indefinite storage, while anxious buyers debate which side of the tariff gamble to choose. Industry insiders see the writing on the wall. This is no fleeting storm. The auto sector is pivoting, and the global reaction could reshape economics, politics, and consumer habits for years to come. Yet nobody holds a crystal ball that can predict whether these policies will endure or vanish in a single stroke of political expediency. As you weigh the extraordinary drama unfolding in real time, consider how the short-term surge in sales might pale beside the longer-term disruption to supply chains, consumer confidence, and international alliances. Is this unfolding power play the spark that drives a new golden age of American manufacturing? Or is it merely the prelude to a deeper economic reckoning? The stakes loom larger with every container full of vehicles stuck at the ports. With so many moving parts, the final chapter of this tariff fight remains unwritten. Will the cost of victory turn out to be higher than anyone bargained for?